Welcome back to Morning Markets on Friday the 10th of September. The key area of focus has really been the meeting of the European Central Bank. Prior to the meeting which we had yesterday, we experienced yields across European bonds grind higher with the anticipation of a moderation from the current ultra-loose monetary policy. During the press conference post-meeting, we heard from President of the ECB, Christine Lagarde. The key takeaways from the announcement were the rebound in the phase of the recovery in Europe's increasingly advanced, with output expected to exceed pre-pandemic levels by the end of this year, supported by the success of the vaccination programme, with more than 70% of European adults fully vaccinated. The bank revised growth expectations up in 2021 to 5% from 4.6% expected back in June, bringing forward some of the growth from 2022, which has pulled in around 1 basis point to 4.6% in 2022. 2023 figure unchanged at 2.1%. The ECB recognised inflation has been elevated, coming in at 3% in August, and have revised their expectations for 2021, 22 and 23 up by 3, 2 and 1 basis points, with current forecasts now at 2.2% inflation in 2021, 1.7 in 2022 and 1.5 in 2023. Therefore, slightly higher, but over the coming years moderating below that target which they have of 2%. But remember, they have got some flexibility around that number, so it's a generally accepted level given the flexible framework which is now operated. In terms of financial conditions, they remain favourable. However, the bank recognised that household and firm debt levels have creeped up through the pandemic, so mindful not to choke growth through a rapid rate hike or challenging the ability of companies and households to service their debt. Whilst a greater number of people are vaccinated, the Delta variant and the challenges this presents due to the need to suppress activity levels does still present a threat to economic growth if you do get a flare-up in cases. This is a fairly robust picture given the view of the ECB opted to leave the current interest rate level as it stands in a range of 0 to negative 0.5%. So they kept the rate the same, but they are in a better position to moderate the rate in which they're buying bonds from the market under the Pandemic Emergency Purchase Programme, or the PEP programme for short, through the final quarter of this year. So you'll see a bit of a moderation in the pace there. Whilst we are discussing tapering of the pace, they did not provide detail on the schedule or the speed, noting this will be done according to market conditions to prevent moving too quickly. The central bank did reiterate that the PEP envelope, which would be maintained at 1.85 trillion, will remain in place for essentially as long as is required. European bond yields reflected by the German Bund moved in around 3.5 basis points on the day in the 10-year yield there, after generally pushing out around 6 basis points in the week leading up to the meeting. So you saw yields push out ahead of the meeting and then just moderate back in slightly. This morning, we've had the updated GDP prints for the 3 months through to the end of July, so a 3-month average there. The number came in at 3.6%, missed expectations by around 0.2%, but demonstrated expansion spurred on by the reopening of the economy, especially within those service sectors. Sterling was slightly stronger relative to the dollar following the news. Thank you very much for watching. We look forward to bringing you up to date on Monday here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.